Money doesn't come from a printing press. Not really. It comes from a phone call, a keystroke, a number typed into a screen at a bank you've never heard of at a time you'll never know about. And the strange part is, nobody voted for the people making that call. Let's start here. Right now, in your bank account sits a number. You think of it as money, real, solid, yours. But that number isn't sitting in a vault somewhere. It doesn't physically exist. It's a promise, an entry in a database, and most of it wasn't created by any government at all. Here's why this matters today, not just as trivia. Every time interest rates move, every time inflation eats your paycheck, every time a bank runs out of money, the root cause traces back to one uncomfortable fact. Almost no one understands who actually turns the money tap on. So let's open it up. Step 1. You're taught in school that governments print money. Technically true, but almost irrelevant. Physical cash, the paper stuff, makes up a small sliver of all money in existence. In most economies, it's less than 10%. The other 90% plus is digital, and it isn't created by the government at all. It's created by commercial banks, the ones with the logos on your debit card. Here's the mechanism, stripped of jargon. When a bank gives you a loan, it doesn't hand you money that already existed in someone else's account. It types a number into your account. That number didn't exist a second before. It exists now. The bank essentially manufactured it, backed by your promise to pay it back, plus interest. This is called fractional reserve banking, and it sounds boring until you realize what it actually means. Private, profit-driven institutions are the primary creators of a nation's money supply, not the government, not the central bank. Banks chasing loan volume. Now, here's the twist most people miss. Central banks, the Fed, the Bank of England, the ECB, don't directly control how much money exists either. What they control is the cost of creating it. They set interest rates, which is basically the price tag on new money. Cheap rates, banks lend more. More money gets created. Expensive rates, lending slows. Money creation slows. So the honest answer to who decides how much money exists is unsettling in its vagueness. It's a negotiation between central banks setting the price, commercial banks deciding how much to lend, and millions of individual decisions by people like you deciding whether to borrow. No single hand is on the lever, and somehow that's supposed to make you feel better. Let's talk about the hidden mechanism, because this is where it gets uncomfortable. If banks create money by issuing loans, then money supply doesn't grow because an economy became more productive. It grows because people took on more debt. Growth and debt aren't separate stories. In this system, they're the same story wearing two different masks. That means the total amount of money in the world is structurally tied to how much collective debt exists. Pay off all the debt everywhere all at once, and mathematically, most of the money supply disappears with it. Not metaphorically, literally. The system requires debt to exist in order for money to exist. Now contrast the hype with the reality. The hype, central banks are all-powerful puppet masters, controlling the economy with precision. The reality, they're more like a driver adjusting the speed of a car they don't fully control, on a road built by thousands of banks making thousands of separate decisions, all reacting to each other in real time. 2008 exposed this. Banks had created so much money through loans, much of it against inflated housing assets, that when the loans went bad, the money that had been created started vanishing just as fast as it appeared. Trillions evaporated, not because someone burned cash, but because debt stopped being repaid, and debt was the thing holding the money supply up. Zoom out further, and the implications get bigger than any single crisis. If money is fundamentally created through debt, then an economy that needs growth isn't a metaphor. It's structurally true. Slow down borrowing too much, and the money supply itself can contract, dragging the whole system backward. This is part of why central banks panic over deflation more than inflation. Falling prices sound harmless. Structurally, they're a warning sign that the debt money engine is stalling.
So who decides how much money exists? Not a villain in a boardroom, not a government stamping bills. It's a diffuse, self-reinforcing system where banks profit by creating debt. Central banks set the price of that debt, and the rest of us live inside the number that results. Which raises the real question. If the money in your account only exists because someone, somewhere is in debt, whose debt is it really?